So thank you very much for joining us, Pure Intelligence members. This is an exclusive event for you guys, so we really appreciate your joining us. And I'd also like to extend a special thank you to our speakers, Charles Cooper and John Ryan. I've known both of them for many years, and they've patiently answered my questions when I worked at American Banker newspaper. Charles is the Commissioner of Banking for the great state of Texas. He took the job in December of 2008, which is not exactly the easiest time to take over a supervisory job. Congratulations on your upcoming 10th anniversary, Charles. 10 years is nothing compared, though, to the 45 years that Charles has had in banking. He began his career at the FDIC as an examiner, and after a dozen years at the federal agency, moved into the private sector. He's been a chief credit officer, a bank director, a consultant, and a private equity investor. So it's no exaggeration to say that Charles has seen this industry from every angle. John Ryan joined the Conference of State Bank Supervisors in 1997. 21 years, John. It doesn't seem quite that long. John's been the president and CEO of CSBS for more than 7 years now. Earlier in his career, John worked for the House Financial Services Committee and also as an industry consultant. As for me, I am Barbara Rehm. I spent 26 years at American Banker newspaper, rising from reporter to the editor-in-chief. For my last 3 years at the paper, I wrote a column mostly about the implementation of Dodd-Frank. I joined Promontory Interfinancial Network a year ago to help launch Pure Intelligence. So with the introductions done, I just want to attend to a few housekeeping items. Your lines are muted to prevent any distracting background noises. But we do want your questions, and you can type them in the space to the right on your screens. We are recording this webinar so we can post it on Pure Intelligence for anyone who wasn't able to make the webinar, because I know it's election day and maybe some of you guys are out voting midday. So let's get started with a broad question about what's worrying state regulators right now. And I'd like both Charles and John to pick one thing from each of these two categories. And I don't mean to be so specific, but there's so many things to talk about that I'm trying to narrow it down a little bit. So we're going to start with the biggest outside threat you see to the industry right now. So not things about the business of banking, but outside the business of banking. What are you most worried about? And Charles, we'll go ahead and start with you.
Okay, Barb, thanks for that kind introduction. Can you hear me okay?
Absolutely, thank you.
Okay, great. Well, generally speaking, our banks and community banks in general are doing very well right now. But what worries me or keeps me up at night, as some people say, or whatever you want to call it, is the danger that we are facing from cybersecurity issues. And I don't think we can talk about it enough. I talk about it all the time if I get a chance, so here's another chance. The thing is that it impacts everyone and certainly impacts our banking system. So after the first round of the banks utilizing the Cyber Assessment Tool, or CAT, our banks, or some of our banks, all of our banks reached the baseline the first time, either the baseline or much higher. Now, as we go back into them on the second time, and sometimes a third time, in some cases, what we're seeing, and I've heard from other commissioners, is that some bankers are satisfied with being at the baseline. And some of them are thinking that the first time they went through that this was a project that they had to complete, and now it's complete, so they don't have to do anything else. And we kind of call this the compliance mentality, which says, tell me what you want me to do and I'll do it. So when you look at the bad actors, on the other hand, they're not satisfied with the baseline. They are becoming more sophisticated nearly every day, and nearly every day, more of them become involved. And obviously, this is not a good trend. So, Barb, one of the things that we like to say is that, as you know, banks have a credit culture. We always talk about what's your credit culture. Well, they also need to have a cyber culture. everyone in the bank needs to be involved. You cannot just hire one person and say, go fix this. So it's a job for everyone. We say it's from the back room to the boardroom. And so we are constantly telling and preaching banks that they have to do more. They have to become more involved. They have to become involved in FSISAC as an example, and many other things. So it's not just the banks, it's all the businesses. We deal with it at the state level, we deal with it at the federal level. So it just, as I said, it impacts everyone, and we all have to work together to figure this out.
So the threat's growing, and bankers basically need to keep evolving with the threats. That's what I'm hearing. Is there anything specific that you think, you know, the bulk of your banks are overlooking?
Well, again, I think maybe it's apathy until you get hit. All banks generally at some point in time have been hit with something, but to varying degrees. If you turn away the attack, then possibly you become complacent, and the attackers are just becoming more sophisticated, and we have to evolve with it.
All right. Okay. I gotcha. Great. John, what do you think the biggest threat outside the industry is?
So, one, I wanted to add a couple things to what Charles is talking about in terms of what we've been doing on the cyber front. And this is going to morph into my issue, which is a banking issue, but it has non-bank components to it. So one, on the cyber front, we have focused on turning this into a risk management issue for financial institutions. It is not a compliance issue. And I think that's, you know, underscoring Charles' point on this. And Charles, as I'm tooting his horn, has been a leader on this front. Going back a few years, we launched an executive leadership of cybersecurity program trying to translate cyber issues into something that senior management can understand, and that banks could better, senior executives could better understand their own risk assessment and their own risk profile. So that's an ongoing, evolving thing. We've worked through the state regulators have a voting position on the FFIEC, worked through the FFIEC to really nudge the federal regulators in the direction of creating a tool for banks.
And that's the tool that Charles mentioned, right?
Yeah, and that's the tool Charles mentioned. So I think that will continue to evolve because it shouldn't be a compliance effort. We should continue to evolve to the risks. Charles talks about banking being, you know, the banks having their own credit culture, but banking in general relies on confidence. And so I think that's one of the greatest risks out there is there something that shakes confidence, whether it's in the bank system or outside the banking system around cyber? We have an evolving payment system of, and, you know, I won't name names, but, you know, payment providers that connect up to banks, that operate independently of banks, and confidence has been created over the last 100 years. We created the Fed to really create confidence in our payment system and the FDIC. So we have an environment of consumer confidence, but some of our ability to control those risks is challenged. And so we are focusing on cyber, not just on the bank side, but on the non-bank side. And in the process of developing examination programs, some states have already come out with their own regs that apply to non-banks.
When you say non-banks, do you mean third-party providers to banks or non-bank competitors?
It could be both. Okay. So it would be third-party providers, or it could be the competitors themselves. So people in the money transmission business that are facilitating rapid payments for consumers.
Right. And that's one of the things that makes cyber so scary, is that a lot of it's beyond your control, like outside your walls of your own bank.
Yes. So the states license, and this wasn't the original purpose of licensing, but license a lot of these non-banks as, for instance, money transmitters. That goes back to the days of, you know, the earliest days of Western Union, where we were requiring sort of a dollar for dollar holding either in the bank for whatever consumer funds they're holding and transmitting and the couple days that it took to transmit them, or some sort of capital equivalency. This is now evolving into something quite different in terms of ensuring that the money is still there, and cyber has to be a component of that. Security has to be a component of that money transmission supervision. So something we're putting a lot of thought to on the non-bank side, but it has a direct impact on banks because a loss of confidence in payments, I think, will impact all banks.
Right.
So that's one that I'm thinking about. We also were going to talk, I think,
I was going to say, I wonder if we shouldn't just talk a little bit about the fintech charter that the OCC is, creating a path toward. And I know that CSBS is. Sorry, Charles, you want to talk?
Barb, I'm sorry. Before you get into that, John, would you go into what CSBS is doing on the training side, because I think that's so important to state regulators and bankers.
So our board earlier this year approved out of we have funds from the global mortgage settlement that were supposed to be used to improve non-bank supervision, and so out of those funds, the states have dedicated at a minimum $1.5 million for cyber training for state examiners. We'll train at least 1,000 examiners on cyber and non-bank examiners. So again, getting to this idea of the whole ecosystem of cyber, bank and non-bank.
Right.
So Barbara, as an example, we have IT specialists that go in and do these examinations, but now we're going to have, by the end of 2019, all of my commercial examiners and all of our non-bank examiners that do MSBs are going to go through this training. And so when they go in and talk with the CEO of a bank, hopefully they will be able to converse about this threat, and I believe that'll help both us and the banks and the non-banks evaluate this problem.
Yeah, no, that's good. That's great.
And Barb, I did have another issue, maybe we'll get to this later, that it extends from bank to non-bank, but it is a high-level potential risk, and that's around liquidity, and as a subset of liquidity, funding and funding for the community bank model. So
right. Well, that was what we were going to get to for the. I started out with there's going to be two pieces to this: the threats outside the industry and the threats inside the industry.
Yeah.
So you want to take it from there. You think liquidity may be a threat inside the industry.
Yeah, I think it comes from both outside and inside. And looking back to the financial crisis, and before you can see some of these issues, but in the roots of the crisis, I think there are a couple things that, and then we can get to the fintech aspect of this as well, but that raise challenges for banks going forward on the funding side. So regulators like core funding, like deposits. It's seen as more stable funding. From the FDIC's perspective, if a bank fails, it has more residual value than broker deposits. But we have some dynamics going on here. I'm the son of a banker, and so I started hearing the roots of this back in the 80s. My dad was upset about the emerging money market industry and thought that the federal government would end up bailing them out at the time, and that they didn't have the same compliance costs that a bank did. Well,
your dad was right.
Fast forward to 2008, and the federal government did back the industry, and then we had Dodd-Frank, and so there's some regulation in there, which may actually, which still doesn't address the issue that funds can charge higher rates and don't have exactly the same compliance costs, but try to address some of these risks. But also in Dodd-Frank, they're the roots of some other things, very reasonable, but the liquidity coverage ratio in Basel III create greater incentives for the largest banks to hold deposits, core funding. And there are very good policy reasons behind this. It really, in my view, I think there are multiple sources of the crisis, but really the heart of the crisis was a collapse of confidence, back to this confidence issue. But confidence coming out of the back door of the bank, not the front door, not the run on the bank. It was a run between banks. And that short-term funding that the largest banks relied on, dried up. So responding to that, the Dodd-Frank and regulators have been incenting large banks to look at their liquidity and have more stable funding. Well, fast forward to now, and now a rising rate environment, you see the largest banks really leading in raising rates. They have more incentives and are looking to more core funding, and smaller banks may be having a harder time competing for that funding. Yet there's an expectation that they have core stable deposits. And then there are other incentives around if you become less than well capitalized, that your funding sources are limited. So there are a lot of things going on. And then the money market mutual fund, we were going basically from a zero rate environment where this competition didn't play out. So I think it's going to be playing out a lot more over the next couple of years in a rising rate environment and more challenging for smaller institutions. And then I can get to why I think that matters.
I was going to say, is that an unintended effect, though, on community banks, competitive effect?
Yeah, it is an unintended effect. And why? And
what should community banks be doing about that?
So I think I'll let Charles speak to that a little bit more, but you did see some acknowledgement of that with which relates directly to Promontory and the work that you all do in carving reciprocal deposits out of the consideration of broker deposits. But the FDIC has kind of opened the door to looking more at their definitions around broker deposits and thinking about the broader funding context.
Right.
Charles, it's a tricky issue.
Yeah. Charles, do you want to weigh in on any of this?
Well, just briefly, it reminds me when I first became commissioner, after 2 weeks on the job, we had to close a bank, and it was because of not because of bad loans, but because of lack of liquidity. They actually could not meet their cash letters. So we've been dealing with it for a while. And Barbara, I think I mentioned to you, I call it the banks that are running hot. Where they have a high loan-to-deposit ratio, less liquidity than they've had before. As John mentioned, more reliance on core funding. And when you get down to why this happens, you look at it's kind of common sense. There's more, as John alluded to, there's more competition now for core deposits, and some of that is coming from the big banks, and we haven't seen that before or as much. In Texas, as an example, and many other states, we have a very high loan demand, so bankers obviously want to try to meet that demand, and then I think it's just really trying to make more money. The bankers are always trying to find ways to make more money. So, as anything else, it's a balance, and so what we're doing, and I think a lot of the other states around it, and in the work group John talked about, is we're going out and doing targeted reviews of banks that exceed some of these parameters and trying to determine if they have what's needed to basically evaluate their cash flow requirements.
That's interesting. So do you think that, is that an emerging issue for community banks that state regulators, federal regulators too possibly, are going to be cracking down on how much liquidity banks have, or encouraging them to get more liquid, or maybe make fewer loans? I don't know. I'm not sure how this all works out.
Well, it's a balance. I'm not sure cracking down would be the term I'd use, but I think we are looking into it. And I know the FDIC and the Fed is too. We're sharing the information when we do these reviews. We're sharing the information with our federal counterparts, and it is a evolving issue because competition for core deposits, or what we call, when I was looking at banks to buy, sticky deposits, is just increasing.
All right. Do you have any advice for banks on this?
Well, everything is in balance. You speed somewhere else, you've got to slow down at another point. So it's just like anything else. You got to do things in balance.
Right. Okay.
I think some level of awareness of what's happening out there is important for all financial institutions, and I'll just get to why I think it matters from where we sit. So it matters, as Charles has referenced, that, you know, those hot funds can move out of the bank very quickly and create liquidity issues to the point of failure. And we did see that multiple times in the last crisis. And those are much harder to deal with from a supervisory perspective because they happen very quickly. Mm-hmm. It's not the slow, long bleed of credit losses. The other reason that it matters to us, and something that we observed, and we've been dedicating a lot more resources to understanding the industry and its outputs. And if you look at the crisis, there's a really interesting research paper in the works on this. And 2006 lending levels to 2010. And this particular paper looked at, I think Jeremy Stein is one of the authors, former Fed governor. The largest, he looks at the 4 largest banks in the rest of the industry, but this plays out much more in the community bank sector, which we know does, we don't have great measurements, but about half of small business lending. So the largest banks went from from their 2006 levels to their 2010 levels to, I think it was about 40% of the lending they'd done for small business in 2006. I might not be getting this exactly right, but I'm close. And then recovery to 2014 ended up at about 50+% of the 2006 levels. And then the rest of the industry went to about 66% from 6 to 10, and then recovered to about 80% of small business lending. So different models produce different results, and you see particularly a concentration of small business lending and the relationship lending and customized lending in smaller institutions. And since small business is so important to our economy, that if the funding isn't available to fund these loans, it's going to have a broader economic impact. And from where we sit, we're concerned about local economies, state economies, and that banking could be an engine of growth for those economies. So this is one of the reasons that we care, and we should think about it. There were perfectly good reasons to address liquidity issues at our largest banks, but we need to just be aware of the whole picture and think through some of these policy questions.
Right. Some of the, yeah, I get it. And so you mentioned that 2155, the Dodd-Frank rollback that happened in May, did affect reciprocal deposits. And you mentioned that the FDIC is actually looking at they're taking a broader look at broker deposits, you know, as a whole. Do you have any insights on where they're headed or when we can expect something?
So no, not necessarily insights on where they're, other than there's a receptivity to talking about it, and there was an understandable reluctance previously to talking about it, because from where the FDIC said a greater reliance on broker deposits, they believe, means less residual value in a failure. But I think there's a recognition that the world is changing, and so how do we address that with, you know, pure online play banks? So you look at Marcus, Goldman Sachs, which has started up recently. They're really competitive on rates, and so some of the issues around broker deposits and looking at a national rate and getting into the weeds on this doesn't take into consideration, it's based on branches. It doesn't even take into consideration a big player like this. So I think there's just a recognition that things are changing in the world. One, the segment that we're particularly focused on having core deposits, I think there's a greater reliance on broker deposits among our larger banks, that they deliver economic value, they're critical to the small business lending environment. Let's look at the whole picture.
Right.
But it's not without risk.
Right. You know, and the FDIC has a new chairman, and I know, Charles, when you and I talked in preparation for this call, you were saying that she was planning on taking a fresh look at everything. And one of the things I think I wanted to just talk about was just, you know, moving beyond specific stuff, just the whole, you know, is there any regulatory relief coming for community banks? You know, we now have Trump administration and regulators. Are you more optimistic about regulatory relief, or maybe, since you're a regulator, more concerned about regulatory relief?
Well, I tell you, I wish you could see how much I'm smiling right now, and some people say I don't smile very much. But the 2155, the bankers in general just said, give us something. And so something came out of 2155, and we may get into detail on that a little bit later. But I want to talk about what you just said. So when President Trump took office, he had the ability to appoint possibly more high-ranking federal bank regulators than anyone else, or at least the timing was right because everybody's term kind of came together at the same time. But before his appointment, when I testified before the Senate Banking Committee on Reg Burden last year, and then I had the then heads of all the federal agencies on the panel with me, I made the statement that how we all run our agencies has an impact on Reg Burden, and I firmly believe that. Possibly more impact in some cases than the regulations. So after Trump made the appointments that he has made, I'm just so glad to see the new faces take office. And let me just briefly mention some. You mentioned Chair Yelena McWilliams. I'm going to say for her, just what a breath of fresh air she is. She is looking at everything. She's not taking things at face value. Recently at our community bank conference, she talked about her transparency initiative. And so she's just doing everything and receptive to changing things. And I just think that's so important. At the Fed, we have the Dodd-Frank mandated vice chair in charge of supervision, Randy Quarles. He's a businessman. He is beginning to what I call make his mark. He was our keynote speaker at our conference in St. Louis recently, and he's now, understand, on a tour in rural America just listening to bankers. Jay Powell, who was understood community banking when Jay was a governor, now he's chairman, and so I think he can bring that forward. That's so important. We have Mickey Bowman, who is the Kansas Banking Commissioner, who has been nominated to be the first Dodd-Frank required community banker on the Fed board. She hasn't been confirmed yet, but we're certainly looking forward to that confirmation because Mickey understands community banking. And then we get over to the Comptroller of the Currency's office, Joseph Otting, a career banker, as y'all know, and he is looking, again, kind of like Chair McWilliams, he's looking into everything. He has talked about BSA reform, talk about CRA reform, and these things really haven't been talked about previously. And as I kind of like to say, Director Mulvaney at the Bureau of Consumer Financial Protection, which I still have a hard time saying that. You may not like what he's done, but he sure has changed things, and he's shaking things up. So I think we have some very, very highly qualified and gifted individuals, and they understand community banking. And as I said earlier, how we run our agencies impacts Reg Burden. And I believe that these individuals that are now at the reins of these federal agencies are going to do the right thing in that regard. I'm so excited to work with them.
So it sounds like the feds and the states are working together pretty well right now. Would you agree with that?
Well, we've always tried to work well together. I think in some cases, Washington, being what Washington is, sometimes made it hard. I would say, as an example, during some of the crackdowns, I would kind of laugh to say when Washington sneezed, the Federal Reserve banks would take a cold. But I believe things are, and everything ebbs and flows over regulation period, and again, I've seen a lot of it, but I think things are, the stars are aligned, I think, to be able to work together closer than we have before.
That's good. I wonder what you think about, did you see that Wall Street Journal story today about the ABA and the Bank Policy Institute sending a petition to the federal regulators saying they wanted a rule saying guidance is just guidance. It's not something you can be cited as a violation for. And I think it was September, the federal regulator said guidance is guidance. So I'm not really sure why, apparently the ABA and the Bank Policy Institute don't think that's really working. Do you have any thoughts about it?
I didn't see that. I heard about it, but I haven't read the article. But it has been a problem in the past, and it's easy for examiners to say, well, you're violating the guidance, and guidance is not statute. It's exactly what it is, guidance. And I'm glad to see this is coming to the forefront.
Oh, so that could maybe help with regulatory burden too, then.
Pardon me?
That could probably help with regulatory burden as well.
Oh, no doubt about it.
Okay. John, anything you want to add to that?
Yeah, I think so. Barb, you said, as regulators, things that we're encouraged about, things that we're worried about. We also do worry about the pendulum swinging too far, and we commented, for instance, on the Fed's one of the early proposals around the enhanced leverage ratio for the largest banks. We're concerned. That's one where we're concerned because potentially, and I emphasize potentially, that could allow the largest banks to reduce their capital by an amount equivalent to the entire FDIC fund. And so what's changed that has us thinking that what's the calculation that there's potentially less risk posed by our largest institution? So we are concerned overall that we retain some of those lessons learned from the crisis, that there is still risk. There always should be risk in our banking system, and we are firm believers that there should also always be failure. Failure may look slightly different or significantly different in different types of institutions, but failure should be a possibility for all institutions. So kind of baking in that too big to fail concept is a concern that knows no party. It's a Washington issue and something we pay a lot of attention to.
All right. And the leverage ratio, though, isn't there something coming too for community banks on that front?
Yes. So another aspect of the reg relief bill is an option. You could opt into a community bank leverage ratio. And Charles, if you want to say a couple things. Charles has been a strong advocate on this issue. And for the audience, Charles is a past chairman of CSBS, also our current FSOC representative. So, I mentioned that the states have a voting seat on the FFIC. So FSOC coming out of Dodd-Frank on systemic issues, we have a non-voting seat, and Charles fills that. So he kind of seen the spectrum, but has also, like most of our members, been frustrated with the growing complexity of regulation and capital.
Especially capital.
Yeah. The amount of pages in the call report dedicated to just figuring out what your capital is,
right,
is
there any sense of when those rules will be proposed? And do you think that most community banks will opt for that, or maybe not?
It's probably going to depend on what it looks like. But we're a part of this is a maybe first that written into the law that the federal regulators need to consult with state regulators in drafting this rule. So we have to be careful in what we say, since we are part of a consultative process. But Charles, anything you want to add to that?
Barb, on 2155, it's Title II created our Section 210 in Title II created the community bank leverage ratio. And if you remember on Chairman Henserling's bill, there was something similar to that. But this particular bill says that if the tangible ratio is, if the bank is under $10 billion and the ratio is between 8 and 10%, to be determined by the federal regulators in consultation with the state banking regulators, then they basically get out of having to risk base all their assets. So it gets rid of the risk base, the leverage ratio and everything. So what we're doing right now, as Jan said, is we formed a CSBS, we formed a work group that we've had several meetings on, because you have to determine what the, if you will, the numerator and the denominator is, and then you've got to determine, is it 8%, is it 10%? And I kind of laugh, because when you ask a regulator how much capital do you need, generally speaking, it's more. Right. So, but we have had our first meeting with our federal counterparts to talk about this issue, and we'll have further issues. And it really brings in a lot of things. For instance, if you pick a ratio, and I'm just going to say you pick 9%, well, how is that determined? Well, we kind of think that it should be something that's readily available to the bankers and to the public, if you will, is where does that number come from? So we thought about Tier 1 leverage ratio, for example, because it's out there in the call report. But we have to make that determination. So there's a lot. The devil is in the details. Right. And then what happens, for instance, whatever the number is, a bank elects to do that, and then what happens if it falls below that amount? Do you become less than well capitalized, or do you just fall back in the old regime? So there's a lot of issues to be dealt with, and I think it's going to impact the way community banks think about capital.
Right. So,
yeah, and that's a critical issue to answer. And I think as a matter of the process, as Charles has mentioned, the federal regulators are focused on this one. Next steps, I don't know, but some notice of proposed rulemaking or something along those lines. We're not into an actual proposed reg yet.
Any sense of timing? Like sometime next year, we're going to have a new leverage ratio for community banks?
That wouldn't surprise me.
Okay, I mean that's a big deal.
Yeah, one thing I wanted to add to this. Significant focus for us has been to bring better data to policy decision making, and that just hasn't always been the case as Congress legislates or as we draft regs. So on this issue, they're just about all community banks would qualify somewhere between 8 and 10% for this. We have been sponsoring for the last 6 years a research conference, and in 2013, the Dallas Fed presented a paper that compared, looking backward at failed institutions, the application of a simple leverage ratio and then the application of a standardized Basel approach, and found that with all its complexity, for a more simple community bank business model, that the standardized Basel approach was no more predictive of failure, no better a regulatory tool than a simple leverage ratio. Now, we do like aspects of risk-based capital, but I think that's important to recognize that for at least that model, this very simple calculation, without all those pages in the call report, so therefore it's really not reg relief in the way people talk about reg relief, which is though you're trading off something.
Right.
You're actually maybe getting towards a more safe and sound institution because they can easily calculate it. They're not spending all their time on this and getting the desired regulatory results. So I think we need to even think differently about when we're talking about reg relief. It always sounds like it's a trade-off. It's a trade-off in consumer protection. It's a trade-off in safety and soundness. That isn't necessarily the case.
Well, in reg relief, in some ways, the Fed just put out those proposals about tiering regulation based on risk and asset size over 100 billion. They have 100 to 250, 250 to 500, over 750. I mean, and that is, while maybe not relevant to the people on this call, it is at least a step in that direction of more tiered regulation. And tiered regulation is another way of doing regulatory relief, really. So I'm going to interrupt our conversation just to answer a question that has come in from one of our listeners, and that's any discussion by the FDIC to increase the insurance limit from the $250,000
million. Yeah.
Sorry, 250 million.
No, yeah, I think they have an M there, but it is 250,000.
Right,
yeah.
And that would have to be a congressional thing, wouldn't it?
Yeah, that would have to be a congressional thing. So I have not heard anybody talking about increasing the account. And actually, that was a fight at the time. Jeb Hensarling wasn't in the majority at the time, but strongly fought increasing that because he thought that put the taxpayer, even though the FDIC is funded and has always been funded by financial institutions, we have seen failure where the taxpayer has had to step in.
Right.
So, that was the more conservative philosophy at the time was opposed to increasing the amount. And I just haven't heard about that at this juncture.
Okay.
Charles, any?
No, I haven't heard anything. It would be a very interesting discussion, though, I think.
Do you think we need to raise the limit?
Well, I saw the question come up. I have to say that I haven't thought about that. When we went from 100 to 250, how long ago was that, John? 10 years ago?
Yeah.
Maybe longer than that. So there was I would say at this time, we probably have other things we ought to address, but again, I'm not a politician or I don't see it as an issue at this point, but I'd have to think about it some more.
Okay, sounds good. I didn't want to, I've kept this mostly at a high level, but I wanted to ask about one specific thing, which is CRA reform. I realize it's separate from the 2155 rollback rule, but does have potential to reduce regulatory burdens. And I wonder, how involved state regulators are in the CRA reform debate and whether or not you guys think that the federal regulators are headed in the right direction. Is there anything you're worried about as far as CRA reform goes? Charles, I'll let you start.
Well, it's been a long time since the act came about in the 70s, I believe, and the world has changed so many times since then, and I get concerned about how the regulators that are trying to examine for CRA, they try to apply old standards to new technology, and it's pretty hard to do. So I think something's got to be done. I also get a little bit concerned when I see a community banker that is doing everything he can, and they question why they have made loans over their internet connection to somebody outside their community. So again, we've got to go through there and start that. I think it's the right. I'll give Audie credit. He's brought it up. It's now being discussed. Now the other agencies are talking about it, and I think we need to talk about it. It is a huge deal.
If you got to wave your magic wand and change one thing about CRA, what would you change?
Boy, you always ask hard questions, Barb. I can't say one thing. It just has to be updated to meet the what's going on today. And
I hear you.
I think so. There are concerns all around the whole CRA community, and this is not something that we've tended to focus on a lot as an organization. So we're having to dive deep into CRA now because this is going to have significant consequences, any change, and start to develop our views and think about this in ways that we haven't probably in a long time. But the consumer advocates have argued for change around CRA. They tend to want to pull more things in to get credit for CRA.
I was going to say, everybody agrees we need to change it, but there's not very much consensus about how.
It's difficult, but I think we do need to step back and focus on the intent, which is that where you collect deposits, you have some obligation to lend. And so that deposit taking for some that had a physical presence and just one city or one state, and that became their lending area, that doesn't make a ton of sense. And I also, as we have banks that have grown significantly since the creation of CRA and are collecting deposits on a nationwide basis, there should be some connection to where they're, and it's not a dollar for dollar. That's not the way our banking system works. You're supposed to be able to collect where there's excess capital and invest it in other places. But if we're limiting our options, our banking options, here's where you put your deposits, and then there's no local lending happening, that's a concern. And whether it's a metro area or a rural area, and CRA has been historically really focused on urban inner city areas, I think a look at the bigger picture should be a part of this review.
Okay, that sounds good. We have another question. The manner in which BSA is enforced has forced banks into the role. Can you open that up?
The Gestapo.
Yeah, no kidding.
Any relief in sight.
Yeah, good. Well, I know Otting is talking about that. You mentioned that, Charles. Maybe we should just open that up to, again, if you could change the way BSA is enforced so that banks aren't in the role of the Gestapo, what would you do?
Well, I have a really radical one, but I throw it out there just for us to think differently. Technology should make this all easier than it was when the Bank Secrecy Act was first designed. So you, in theory, could take the bank out of the role of all the reporting and the judgments and have a third party evaluating collectively on bank by bank, but also across banks, this data and start tracking for risk and all of this. So the bank just becomes the provider of the data, right, rather than all the analysis. It's very big brothery, but I'd mentioned our research conference. Part of our research conference is an annual survey, and I think Texas, the banks are always among the most responsive given our leadership in Texas. but BSA was rated the highest compliance cost of all compliance issues. So there's a need to do something differently around this. I think technology could be part of the solution, but that's one solution. Do you have some sort of utility, or is there some way to gain direct access to the information and take the banks out of all the reporting requirements?
Right.
So it's a radical thought that may have a whole stream of commenters stepping in and saying, that is the worst idea I've ever heard.
Actually, I think bankers would like that.
Some would, but it means access to, you have access to all banks' information in theory, but in reality, creating that connectivity and then the risks associated with that are something real. You could also apply that to safety and soundness, and there is an effort going on right now. The FDIC has a pilot with some of the core service providers on greater connectivity that might make it easier for those service providers' customers to get information to their federal counterparts and their federal counterparts and state counterparts to look at that information as part of the examination process.
That's interesting.
So,
Charles, anything to add?
Well, just briefly, the one thing that we've seen people say, do this, do that, raise this limit. Other people say decrease this limit. One of the things that CSBS is that I think, John, that we came out with, or maybe I'm dreaming because I thought of it, but the importance that the bankers say that they file all these reports and it goes into the black hole and it doesn't do any good, so they're doing all this for naught. And then the law enforcement says, well, we need more information, not less. And so I believe in order to understand where you need to go, you have to understand this issue. So I know several of us had recommended that a report be done very quickly to evaluate that problem right there. Is it a black hole? Does law enforcement need all this? If so, is it possible to try to get some of the bankers say that they file these reports and they never see anything. So,
right. So maybe get an honest broker to take a look at the status
quo. Yeah, we would like
to,
and I think we recommend, or at least I recommended it, it'd be the Treasury that kind of takes that report, get it done. They've got the ability to do it, get it done, come out with a recommendation so Congress can have something to fall back on. And we've been talking about it, and still we haven't done it yet. So I just think it's time to get the report done.
Yeah. Okay, that sounds good. So shifting gears a little bit, I just want to talk about the future of community banking. What do you think community bankers should be doing today to prepare for tomorrow? And I realize that when it comes to particulars, that answer will vary for different banks, but I'm looking for some 30,000-foot perspective. If you were running a community bank today, what would you be doing to ensure relevance, to ensure you don't lose your customers to a startup or a non-bank or really the mega banks? Long way of asking you how you see the community bank business model evolving. Charles, we'll start with you.
Another hard question. Well, a lot of it depends on where you are, I think. It's how you respond, because as an example, in some of the I won't say rural, but suburban areas anyway, there's I think probably a better opportunity to keep your core deposits and less competition. But when you get into the more urban areas, I think that increases. So a lot of it has to do with what your present clientele is now. But you're going to have to, regardless of where you are, you've got to change. Now, right now, community banks, we mentioned it earlier, there's a lot of loan demand. So I don't think that the big issue in the next 2 or 3 years is going to be loan demand, even though there's a lot of competition. The big demand is going to come from on deposits, and we talked about that before. What do you do to keep your deposits that you have right now? With everybody changing to this technology, I was heard from a very young person yesterday that was moving money around with an app, and I particularly liked what they were talking about, so I looked it up. And all this can be done, in effect, without a bank. So banks have to adapt to that. It really depends on what your clientele is and what your age of your clientele. So I'm just saying deposits are what you're going to have to get. Loans are not going to be as bad, but with all the competition we've got there from the non-bank lenders, that's going to increase also. So I don't know what the answer is, but you can't just stay where you are right now.
Right. It sounds like you are basically saying, go out and analyze your market, figure out what it wants, and try and give it to them. And I think failure is not something that most banks are comfortable with, or most bank regulators for that matter. But I think that's going to be part of the new community bank model. You're going to have to try stuff that isn't going to work, and you're going to have to figure out that it's not working and shift gears. But I think, it's not a bad thing, but the industry hasn't had to do that much kind of short-term, fast-moving, and I think that's going to be more a part of the future.
I also think that, John, you probably have more detail on this, but from our community bank research conference, we've learned that our banks technology is not viewed as an enemy anymore. It's just viewed as a challenge to try to determine how to harness that technology.
All right.
So I think about a past technological challenge for community banks, and that was the power of the large banks had in the back office and dollars to invest in technology, and out of that the core service providers really became a great equalizer, and that you could have all those technological advantages of a large bank through effectively a subscription or a contract with a core service provider. Well, fast forward to now, we have just a few core service providers, and you hear more and more from community banks, there are challenges in getting the service providers to adapt new consumer-facing technology. So I think focusing on that space and how can smaller institutions adapt more readily to these services the consumers are, and I think every bank needs to be thinking it's just a matter of timing. Everyone is going to want some level of this convenience. They may still want a physical branch that they can walk into, maybe less frequently. Some aren't walking in at all right now. But focusing on that ecosystem of service providers and how they can enable and again be a great equalizer with the non-banks and the largest banks in terms of the services you can offer. And I would think that community banks collectively, one-on-one, you don't have a lot of power in the contract negotiation, but collectively should have a lot of market influence.
Right, right. I hear a lot of complaints about corporate writers and that readily adapting issue. Okay, we only have a couple minutes. So I'm going to just, last question is going to be this. It's election day, so I have to ask. The consensus is the Democrats are going to win the 23 seats they need to gain control of the House, while the Republicans are going to keep a majority of the Senate. We'll find out tonight if that prediction holds. And if it does, you know, Maxine Waters of California becomes the House Financial Services Committee chairperson. A divided Congress means new laws are less likely, and Democrats may be tougher on the industry and the federal regulators that we've been talking about. So I just want to, you know, quickly ask you what you think the impact of the midterm elections is likely to be. John, do you want to start?
I can go. Yeah, I can go first. So, you know, if there's a change, if things go as, you know, the talking heads and the pollsters guess that there's a divided Congress and a Democratic House, then I think you just have to go and look back 2 years to see what it looks like. In that the House Financial Services Committee was doing a ton of oversight. The CFPB, now BCFP, was up there. I'm not sure how many times they testified, but a lot. You know, true of the SEC, others. So tons of oversight, and I'd say it just flips and it goes in the other direction, lots of oversight. One area that I would expect there to be a lot of attention is CRA, any changes in CRA. Those probably become, I don't know if it's more difficult, but a lot more attention with the power of the gavel to any changes around CRA, and probably any of the regulatory changes proposed by the agencies, but that would be at the top of the list.
Do you think the federal regulators will care?
They always care.
Okay. I think that's true, but I wasn't sure what you guys would think. Charles, you want to pitch in a couple thoughts?
I'm going to wait and see what happens, but I will tell you, Barb, I was just thinking as you were asking the question, when we go to D.C., or when I go to meet with the Texas delegation, or we're dealing with somebody at the Senate, at the Chairman Crapo or whatever, I think that my visits have been probably 50-50 with both sides of the aisle. And we met with Chairman Enserling on our fly-in, and then right after he talked to our 50 state bank commissioners, Ranking Member Waters came in and talked to us. So I think we try to be as neutral as we can in that regard.
All right.
And I think some examples of one we didn't bring up, but the QM provisions of reg relief came from us. It was out of testimony before the House Financial Services Committee. Congressman Barr ended up working with us and proposing this. That got a near unanimous vote out of the House Financial Services Committee. We also had a rural designation issue under Dodd-Frank, and same thing, we were able to get something with close to unanimous view, and a couple of other issues. Right. So they can work across the aisle.
Exactly. It'll be interesting to see. Listen, Charles, thank you so much. John, thank you so much. Everyone on the line, thank you very much for joining us. Really appreciate it, and enjoy the rest of your day.
My pleasure. Thank you.